The president is escalating his global trade tariff war again. Swiss leaders traveled to D.C. earlier today after the president said he would slap the country, Switzerland, with a 39% tariff, which is one of the highest yet. And the threats didn't stop there. The president also said the EU would be hit with a 35% tariff if it does not invest $600 billion in the United States.
It started with a number so small, most analysts didn't even blink, 1.2%. A quiet little tax slapped on gold transactions by Switzerland, the world's refining hub. But here's the kicker. That tiny number translates to $82 million in extra costs for America's $6.8 billion gold imports. And that's just the first ripple. Because in Washington, this isn't just about shiny metal. It's about a $48 billion trade deficit Trump swore he'd close. It's about Fed reserves, bond yields, and the credibility of U.S. markets. And Switzerland? They're playing chess, not checkers, bundling gold with pharmaceuticals and hiding behind banking secrecy. Today, we're breaking down the high-stakes financial standoff that could shake global markets. So hit like, subscribe, and keep watching, because the gold game just turned deadly serious. It all begins with the deficit. The United States is staring at a $48 billion trade gap, and the White House has been itching to close it. Gold, yes, the literal bricks and bars, is part of that plan. Because while America mines its own, a huge portion of what ends up in the nation's vaults, jewelry cases, and manufacturing plants comes from one place, Switzerland. Every year, over $6.8 billion worth of Swiss gold flows into U.S. ports. It's not just for investors stacking coins in safes. It's for jewelers in New Jersey, electronics manufacturers in California, and banks padding reserves. But in July, Bern made its move, a 1.2% transaction tax on non-G7 gold imports. At first glance, it looked like a global issue. But Washington quickly realized this was a U.S. problem with U.S. consequences. The math was brutal. That 1.2% meant $82 million in new costs overnight. For some industries, that's a small bump. But for gold markets, it's a shockwave. Because gold pricing isn't just about buying and selling. It's about premiums, futures contracts, and the delicate balance of central bank reserves. Even a fraction of a percent can send algorithms scrambling, hedge funds dumping, and miners panicking. And Switzerland didn't stop at the tax. They tied it to a condition. An exemption was possible if the U.S. agreed to full origin transparency for all gold imports. In other words, Washington would have to disclose exactly where every ounce came from. For ordinary trade, that's paperwork. For gold, it's political dynamite. The Utah mining lobby, one of Trump's solid red state allies, loved the idea. Transparency would favor domestic producers and sideline certain overseas sources. But the New Jersey jewelers and importers saw a disaster. Origin rules would slow shipments, spike costs, and cut access to cheaper refineries. Two industries, both politically powerful, now locked in open warfare over the same policy. Meanwhile, Switzerland held the real leverage. This wasn't just about gold. They're a pharmaceutical giant, a chemical catalyst supplier, and the gatekeeper of discrete banking. By quietly bundling gold trade with pharma contracts and catalyst shipments, Switzerland signaled to Washington, push too hard, and more than gold gets expensive. Markets caught the scent. The dollar index ticked upward as traders bet on tighter gold flows. Bond yields wobbled, not from default fears, but from reserve strategy uncertainty. The Fed, already juggling inflation and election year political pressure, faced a new headache. Whether to use its own gold reserves to calm the market or ride out the turbulence. And here's where the danger escalates. If the U.S. pays the tax, it sets a precedent that a small nation can extract millions from the world's largest economy with a minor policy tweak. If it refuses, and gold flows slow, investors could start doubting America's ability to defend its reserve credibility. Either choice feeds market anxiety, and anxious markets punish treasuries fast. Inside the Senate, the split was razor thin. Republicans from mining states were all in for transparency. Democrats from manufacturing and retail states sided with the jewelers. In between sat 2 or 3 swing votes who would decide whether the U.S. accepted Switzerland's terms, fought them in the WTO, or sought a third option. And those swing votes were getting calls. not just from lobbyists, but from Treasury officials warning about repo market stress and central bank swap line tensions. What made this fight even more explosive was timing. Global gold demand was already running hot. Geopolitical instability, inflation fears, and central banks stocking up. Switzerland's move added fuel. Gold premiums in Asia jumped. Hedge funds started hedging against a US-Swiss fallout. And in the background, rumors swirled that Switzerland had been stockpiling off-book reserves of refined gold, ready to redirect to friendlier markets if Washington didn't play along. Trump, for his part, saw the tax as a direct insult, a trade slap from a country without an army but with the world's safest vaults. His advisors urged a measured approach. His campaign staff wanted a headline-grabbing retaliation. The balancing act was brutal. Act too fast, and the markets dive. Act too slow, and Switzerland digs in deeper. And just when it seemed like this was a bilateral trade squabble, the IMF weighed in quietly, warning that fragmentation in precious metal flows could impact global liquidity. Translation: if this gold fight spirals, it could ripple into currencies, commodity exchanges, and even debt markets. But that wasn't the whole story, because behind closed doors, Washington was exploring three radically different scenarios, each with consequences that could reshape both the deficit fight and America's standing in global markets. Scenario 1: Wave origin transparency. The fastest way to defuse Switzerland's tax was simple: agree to their transparency demand. Drop the secrecy, show the paperwork, and get the 1.2% tax exemption. On paper, it was a clean fix. In practice, it was political suicide for Trump's mining allies. Utah miners saw it as a betrayal, handing leverage to refiners who could undercut domestic producers. Even worse, compliance would mean disclosing gold origins from politically sensitive suppliers, countries the U.S. publicly criticizes but quietly buys from. Imagine headlines exposing shipments from sanctioned states or conflict zones. The optics could spark both a political firestorm and activist lawsuits. Yes, it would save $82 million, but the fallout could cost billions in lost political capital. Scenario 2: pay the tax. If transparency was too risky, Washington could simply swallow the cost. $82 million isn't catastrophic for a $25 trillion economy, but that's the trap. The moment America pays without resistance, other nations see a green light. Tomorrow, it could be palladium from South Africa, platinum from Russia, or lithium from Chile. Financially, paying would tighten gold liquidity. Futures spreads could widen, raising borrowing costs for businesses that use gold as collateral. Bond traders, sensing weakness in U.S. reserve defense, might demand higher yields on treasuries. In an election year, even a small yield bump can blow a hole in deficit projections. Trump's $48 billion reduction target could evaporate in weeks. Scenario 3: substitute metals. The most radical idea on the table was replacing some gold imports with silver or platinum. Economically, it was a fantasy. Gold's liquidity and universal acceptance can't be swapped out without spooking markets. Platinum is too niche, silver too bulky. Attempting substitution would trigger pricing chaos, crush confidence in U.S. reserve strategy, and hand Switzerland even more leverage. Each scenario had winners and losers, but none offered a clean victory. The White House floated a hybrid: partial transparency in exchange for a reduced tax, while quietly stockpiling domestically mined gold to offset future risks. Treasury analysts modeled it, but even that carried dangers. Partial transparency might still expose politically sensitive suppliers, and stockpiling could drive up domestic prices, hurting jewelers and manufacturers. Meanwhile, Switzerland played the long game. Bern delayed formal WTO filings, letting the uncertainty simmer in markets. They hinted at expanding the tax to cover related goods, perhaps even refining fees, if negotiations soured. Swiss diplomats reassured European partners while making it clear to Washington, this wasn't just a tax, it was a sovereignty statement. Banking secrecy and trade autonomy were not negotiable. Global markets reacted in real time. The gold spot price swung in $20 to $30 bursts within hours of key announcements. Asian premiums climbed as India and China moved to secure extra shipments. The dollar index flirted with multi-year highs, hurting U.S. exporters. The Fed began quietly testing repo market interventions, readying liquidity injections if gold-backed financing started to seize up. Back in the Senate, the swing votes held firm. They wanted guarantees, not just on the gold tax, but on pharmaceuticals and catalysts bundled in Swiss trade. The pharma link was critical. America imports over $8 billion in Swiss drugs annually. Any disruption there could trigger shortages, making the gold fight look like a minor skirmish in comparison. This bundling strategy was Switzerland's ace. By making the U.S. consider not just gold, but life-saving medicines, they raised the stakes beyond finance. Now, every negotiating table discussion carried a humanitarian undertone. Pull too hard, and you're not just risking gold markets. You're risking chemo treatments and surgical supplies. The White House found itself cornered. Trump's advisors began drafting language for a compromise, one that would protect mining lobbies enough to keep Utah happy, shield jewelers from immediate cost spikes, and avoid sparking a pharmaceutical panic. The idea: a phased transparency rollout over 2 years, with exemptions for politically sensitive suppliers, paired with a reduced tax rate starting at 0.5%. But even before the ink dried on the draft, currency traders spotted the leak. Futures markets shifted, gold surged another $25, and hedge funds piled into safe havens. The perception was clear: America was bending, not breaking Switzerland's gambit. And that perception matters. In geopolitics, how you respond to a small challenge sets the tone for bigger ones. If Switzerland, population under 9 million, could pressure the U.S. into reshaping trade policy, what message would that send to larger powers watching from the sidelines? The IMF's quiet warning grew louder. Any sustained fragmentation in precious metal flows could compromise central bank coordination. Translation: if Washington loses this round, other countries might splinter away from the dollar-based gold trade, pushing toward alternative settlement systems. That's not just a trade problem, that's a reserve currency problem. By August's end, the gold chessboard looked frozen. Switzerland stood firm. Washington wavered between scenarios. Markets stayed volatile, and the deficit clock kept ticking toward November's election deadline. This wasn't just a skirmish over gold, it was a warning shot in a much bigger game. A 1.2% tax, barely a rounding error in national budgets, exposed how fragile the balance really is between trade partners, domestic politics, and global market confidence. Switzerland proved that leverage doesn't come from military power or population size. It comes from controlling something the other side can't easily replace. For the U.S., that's a hard pill to swallow. Whether the compromise holds, or whether this explodes into a precedent-setting defeat, will be decided in the shadows of boardrooms and Senate cloakrooms, not in the headlines. The question now isn't just if America can close a $48 billion deficit. It's whether it can still dictate the rules of trade when even the smallest nations can flip the board. If you found this breakdown valuable, hit like, subscribe, and turn on notifications so you don't miss the next move in this high-stakes geopolitical chess game. And tell us in the comments, did Washington play this right? Or did Switzerland just outmaneuver the world's biggest economy?